Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark says while equity markets are less bumpy, they are still very risky. Institutional Advisors investment strategist Bob Hoye on how the markets are stacking up historically and whether it means a bump or a crash. We'll talk to Ross Clark right after this.
Unbelievable harmonies, spectacular performance, Bird Dog and the Vintage Electric Band, the ultimate tribute to the Everly Brothers and Simon & Garfunkel in Oliver, October 2nd, in Kelowna, October 3rd. Buy online and save at ontourtickets.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Welcome to This Week in Money, Ross.
Yes, Jim. Nice to be with you.
Very, very bumpy month so far on the equity markets. Is it going to smooth out any?
Well, you know, that break into the 24th of August was quite something. We were down 16% off the highs in the Dow to 12% on the S&P. I think more like 18 on the Toronto market. And the VIX, the volatility index, was up at 50 during that morning. And the subsequent action, we still see high volatility VIX, which is a measurement of the volatility premiums in the options, still running in the mid-20s, which clearly off the highs, but normally we would see it in the range of the high teens. So there's still a lot of volatility, back and forth, daily action. But the ranges are starting to narrow in, which is good to see. Now, the most recent rallies during this week got up to the 20-day moving average, which is normal once you've had the first hard break. I think we've still got another few weeks here of consolidation as the market goes through what is now one of the weakest stretches of the year. Seasonality, typically we know that September, October are some of the worst months of the year. Typically at the end of October, early November starts the best 6 months. Excuse me. And in this year, if anything, I would say that the seasonality is probably pushed forward 3 to 4 weeks early. So where we've had that major climactic low on the 24th of August, you might, instead of seeing the lows now come out in late October, we're probably looking at a late September, early October from a seasonal perspective. Now, this week coming up, 38th week of the year, is one of the worst. This is where 9/11 happened. I think we're on the 14th year anniversary of that one right now. We take a look at the various things that have happened this time of year. The old adage, sell Rosh Hashanah, which is tomorrow, Sunday, followed by Yom Kippur, which is on the 23rd. That has been just a good window in which to be out of the market, looking to establish positions at the tail end of that. We have this Friday coming up, which is what we call a quadruple witching. That's when you have the expiration of the stock indices, the index futures, options on individual stocks, and options on the indices. So that quadruple witching has been followed by one of the most reliable down weeks after that one. So once again, that would take us out into that same week of the Yom Kippur. Week around the 23rd, where you might be looking for timing in terms of purchases. From a sentiment perspective, we had some very, very extreme numbers from put-call ratios in the last couple of weeks. The Ridex numbers that we mentioned last week, showing that the number of the amount of money being moved from long-oriented funds into the inverse bear funds was at levels that were beyond what we saw at the bottom in 2008, 2002, and 1998. All those are now in place, and typically you would see the extreme in sentiment followed by, and that would be also an extreme in price, and then 4 to 6 weeks later you would see a test of the lows, and if that's successful, that's where the markets typically turn up. So everything is pointing towards the latter part of September, early October, I would say, that if we have put in a reasonably well-tested low, we have a chance for an exceptionally good move there.
People keep bringing up the term Shemitah. What does that mean to the markets?
Well, Shemitah is the Jewish calendar year that the Shemitah cycle that you look at. It's a 7-year cycle, and we are coming up right now on the 7th year of the 7-year cycle, 7th cycle of the 7-year cycle. The last one of these was back in 1965. Previous one to that was at 1916, and that tends to have been a period in which the market was very weak a number of times, not all the times. And I went back on my research and found that the second half of the year, when the market was breaking on those Shemitah years, of which, say, this is the 7th one in this cycle, that you would get an initial support, typically down about 10 to 12% off the market highs. And even though the Dow overshot that on the 24th, the S&P was right into that normal parameter. And you would normally then go into a consolidation phase shortly after. However, if you started to break down by more than a few percentage points after that, there would be a continuation to the downside, and by another 15% or so. That was the norm. So what we have to watch for here is that low of the 24th, that we hold no worse than maybe, say, 1 or 2% below that as we move through this window. And the window is not specific to a day per se as much as it is, let's say, the next month or so. If we can hold through there, then the market has historically had an exceptionally good run. And if we look at the 7 of 7 cycle, what is followed by is what they call the Jubilee year. And the Jubilee year, 1917 and 1966, were exceptionally good years in the market. So I believe that we're into a period, and my analysis of the cycles shows clearly that the years that don't break down into this selling window have been very, very good on the backside. In the years where the market didn't break down, the other market that did have trouble was the bond market. So most recently, that would have been 1994, where the equity market stabilized through this time window in the second half of the year, particularly through July through October. And it was the bond market that gave up ground. So that's the market that I will also be watching. As we move through September, let's see how bonds hold up. We do have the FOMC meeting next week. You've got the Bank of Japan also out there with potential moves on interest rates. So I think there's some things to be watching very closely for in the next 10 days to 2 weeks.
Ross, thanks a lot for chatting with us.
Always a pleasure, Jim.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy, Vancouver. If you have any questions for Ross, you can email him at ross.clark@cibc.ca. Coming up next, market historian Bob Hoye on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to This Week in Money, Bob.
Yeah, hi, Jim. It's good to be with you and our listeners.
People were saying the North American stock markets have been suffering from Chinese disease. In other words, the drops in the Shanghai market affecting what's happening on this side of the pond. Well, today, China has decided that it's going to abandon its attempts to buy its way out of trouble on the equity market, but they have an interesting solution now, Bob. What is it?
Oh, yeah. Well, actually, as you were saying that, they, as we know, and it was aggressively entered and widely reported, that they bought hundreds of billions of stock trying to prevent it from going down. And I just sort of thought now, some would think it was quantitative easing, but I think it was quantitative buying. And so they realize that that's not working, so they have to turn to, and here's the quote I found here, so that instead they'll intensify their efforts to find and punish those suspected of destabilizing the markets. Can you believe it? These guys are so naive. So, but here, there's more to it than that, 2014, June, there was an announcement and a number of other discussions that the central banks had been, a central bank exists to have a reserve to back the currency. One time it was a gold reserve, and more lately it's having dollar reserves in there to back the currency. So, but of course, with their policies to drive interest rates down, holding short-dated treasuries in dollar terms wasn't making any returns for them. So, but this is the thing, is that you don't expect to get any returns out of your reserve. It's like an insurance. So anyways, they started buying equities, or have been. And so, they're in a very awkward place. So if they were buying equities over the last year, that would be at higher prices. Then they get hit very hard, and what does the Bank of China do? Buy more equity. So it's the classic novice's step of averaging down. I mean, these guys are, they're dummies. So, but at any rate, they're turning their anger upon those who destabilize the market, when actually the big bubble in Shanghai went up and peaked in June, like we thought it would. That was where, in previous great bubbles, going right back to 1700s, they usually, in Europe then and London, peaked in May or June of the year. And so there we are. Well, that was nice. And now we're getting into the part where you have seasonal forces here. We all know the one about sell in May and go away. Well, the opposite side of that one is the discovery of, I got a liquidity problem, I'll sell going into October. So, and oftentimes you can see some heavy pressures in September. Well, this one was an absolutely disastrous August around the world. And yesterday I was looking at some indexes here, and so you got the NYA, which is the New York Composite Index, and it set a rounded top, or with a high in May, and then has broken down completely. And so then I looked around, and there was a global equity index, and the VEU it was, VEU, yeah. So I put that one in, and you can't tell the difference between the two stocks. One is global, one is U.S., so then these things are all linked together, and the policymakers are so naive as they think that they have a national economy that they can run. And of course in Canada we demonstrate that all the time, of the futility of having a Bank of Canada, the concept of a national economy right next to a border that's 4,500 miles long with the most powerful economy in the world. So, all of this is really nonsense, and I think a lot of these things are coming home to roost here. So, you had the first mighty whack down. I mean, it was hard, and then you're going to get a number of natural bounces, and this is, of course, what you got at the end of any great speculation, whether it was the South Sea bubble in 1720, or gold in 1980, New York in 1929, the Nikkei in Japan in 1989. They're all the same. Crash, bang, and then a bounce, and then working around for a while, and then down to a heavier liquidation. So the two probabilities here are that, one, a lot of the excesses are still there. Some of them have been wrung out of the market, but there's still a lot of bad business to clear out of the thing, imbalances and margin accounts offside and all that sort of stuff. And then you also have the time of year when things can go wrong, which is October. So what we're doing here now is looking at similarities. I mentioned a number of them, but actually when we're looking at the New York Composite Index, which is the broad market, in 2007 it went up, and then it turned around a bit and then headed down, and then took out the 50-week moving average, and that was critical. That was sort of like in December. And then this one took out the 50-week moving average, 5-6 weeks ago. And then in comparing the two, this washout we're having now, and keep in mind that in 2007, the high for the S&P, I think, was in October 17th or 18th, like that. So it was unusual in sitting a high when you would have a seasonal low, but nonetheless, you had a good washout right down into January. So what I'm thinking now is that this seasonal probability and the fact that the markets still have a lot of problems in them. So I think there's going to be another washout here, and it could look like the one down into January of 2008, then a rebound, and then a lengthy bear market. And why would we think we've had a cyclical bull market? Well, you've had margin debt expand to the moon, spike up, and that high was in April, and then trek back, and then in June, it had another attempt to go up, and then it's now much lower than that. So the market usually fails on the second attempt for margin to spike up, and that would be like 2007, or similar there, and also back to 2000. So there's a number of things. Advanced decline was the other one. That was very positive for the stock market, peaked in April. But again, on that one, we pointed out that the probable high in the market would be after the highs in the advanced declines, and that was indeed the case. So it fell apart with some drama in August. So what we're looking for in the stock market now is another washout, and that would be similar to January of 2008, rebound, and then markets could be discouraging for most of next year.
Now, the Chinese solution sounds like they're going to be arresting people, they're going to be convicting people, and if it's something extreme, or it doesn't even have to be all that extreme, the execution of people. How's that going to encourage people to invest in their stock market in the future?
Well, the bureaucratic mind, using the term loosely, is amazing. But they feel that somebody caused it to go bad, and yet in about April, I remember a news report saying that they were encouraging more new issues to come to market in order to satisfy buying demand. And then in July, when the panic got going, they then prevented new issues from being done, and then they thought, well, if we stop the biggest trading stocks from trading, then it'll clear on its own. So everything they did was absolutely amateurish. But the main thing is that at the end of the business day, the quotes are there, and if they're down 7 or 8% in one day, there's nothing they can do to disguise that. But what they are now doing is trying to find out, and they've got to have a culprit. So maybe it might be like in the Soviet Union in 1937, 1938, where they had the show trials, where they would have these 5-year plans, and then nothing would work. So then they could not accept that it was a systemic problem. They had show trials, and these poor bureaucratic figures were then had to confess that they sabotaged the thing when it just was hopeless and went bad on its own. No, I don't think it'll go that far. I think it'll just all get quiet, and then on the next leg down, who knows what they're going to do then. But if you look at the big picture, Jim, this bubble around the world, most folks around the world know that there was a whole lot of government stimulus going into it ever since the crash of 2007, 2008. And they're going to look and say, well, here's another one, and all of that stimulus, which is essentially wagering taxpayers' money against the bubble, they're going to say, hey, this doesn't work. You guys don't even understand that it doesn't work. And I think we'll have a new bull market in common sense with the public saying all of these government enterprises are absolutely rather foolish and they don't work. So what you have to do is start taking a look at their intentions and what happened. Their intention was to maintain a bubble. It didn't happen. So their methods are wrong, inappropriate, and should be discarded. And this, actually, when you look at it, although a financial contraction is a horror show, but it will instruct the central bankers that they are not infallible, that they indeed are a bunch of fools. And that would be a very healthy thing.
We're speaking with market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Bob, Goldman Sachs has made some pretty interesting predictions over the past year. Now they're saying if oil went down to $20 a barrel, they wouldn't be surprised. Have they been accurate?
Well, I don't know. I think they were bullish a year and a half ago when crude was rising up. We got 107 then. But, to go back the whole big picture on crude oil, the great big high was in 2008 at 147, and that was when the promotion was peak oil, that oil in the ground was maximized and there would be unbelievable shortages and all that sort of stuff. So, of course, we had it on our ChartWorks when, that was incredible, in July it was. We had upside exhaustions on crude oil on the weekly, which then wrote that this is enough to call for a cyclical bear market in crude oil prices. And then noted that if the upside exhaustions came in on the monthly at the end of the month, that then we could conclude that there would be a secular bear market. And that was just straight on chart dynamics. And at that time, the fracking of oil fields was early in the game. It had been successful in natural gas. So the game started, but when we called for a secular bear market in crude oil, there was no need to do any fundamental analysis. It was just straight on the chart. So, but then in the first part of 2014, we had one in McLean's there. The view was that crude oil would rally up maybe into May or June. I think it got to 107. And then I was talking about in the 1930s, we found a good way of looking at crude oil prices, and that was in gold terms. And we found that during the Depression that depending on which quote you're looking at, but crude oil fell in gold terms to 1/3 or 1/4 of the high. So that turned out in the McLean's magazine as I was at a forecast, because it was then, say, around 100, so then it would fall to 25. And when it was actually at 107, that was rather a bold statement. But here we are, we come down now. I reviewed that again, and if you do it to, I forget the numbers, but it's definitely going to fall to 1/3 to 1/4 of the high, and let's just say pull a number out of a hat and call it $27 on WTIC. And so if Goldman's are now got a forecast of 20, okay, fine. I don't know what their foundation is on it, but I know ours is based upon what happened to crude oil in the last great contraction. So that thing. And then also when crude first started coming down last year, immediately everybody said that, this is great because of falling gasoline prices will put more money in the pocket of the consumer and all that sort of stuff. And the view was that if crude oil's going down, and mind you also remember that most commodities have been in a decline since the cyclical peak in 2011. So actually, the argument we used for falling crude price was that post-bubble contraction, most commodities go down, and crude had been held up there because of Middle East problems. And we also wrote that it would be pulled down into a new price regime like natural gas did, and which eventually did. Then when the Saudis got onto it and weak prices and they maintained their production rates, then the story came out that, they were going to try and break the fracking production in the United States, and I think that was just window dressing. I mean, any bureaucrat likes to appear as if he's in charge. It was just straight post-bubble, weak commodities, and then you had technological revolution that natural gas had been experienced before. And also you have a problem in a post-bubble environment. On the grains, for example, is that weaker prices, so then the farmers, in order to maintain their income, the old saying is they plant from fence post to fence post, and they just keep producing more and more. So here's what is going on in fracking of crude oil in the States and the rest of the world, is they're going to be planting from fence post to fence post. And actually, as we speak, each quarter advance in time in the U.S. on fracking, these guys are getting more and more efficient, so their cost of production is diminishing. So this is it. It's amazing how you get into a post-bubble contraction, and you discover many ways to drive prices of commodities lower. But this also has some importance to major industry, or industry and commerce, is because if producer prices are falling, it's typically a pressure on a lot of prices, so businesses have pricing pressures. They find it difficult to keep their prices. It gets very competitive, and then their, of course, cash flows and earnings depend upon good pricing power. So then if they, in the boom times, took on a lot of debt to expand or acquire things, or in the case of too many companies, they were buying their own stock back, then you have a problem servicing that debt. And then along comes the guys at the rating agencies, Standard & Poor's and Fisk and places like that, that they then look at that. So as commodity prices go down, pricing pressures increase, they make less money, they can't service their debt, so then their debt gets downgraded, and lower grade and high grade bonds can become low grade bonds. And so it is fascinating how a post-bubble period, the deflation efforts, forces, just keeps rippling around and out and everything else. Of course, what you have is the regular business cycle continues. So here you had the crash down into 2009. You've had a bull market and a business expansion since. We think that the bull market globally ended in July. Some indexes, like Toronto Industrials, had a high in 2014. But at any rate, it's all working out. So the thing we'll be seeing next due to weak commodity prices will be credit downgrades and dismal corporate bond market. Now, this also spreads out. If you have weakening business and weakening sales and weakening economy, then tax revenues to the government diminish as well. So they then begin to have a difficulty servicing debt. So it's amazing how it all works.
Now, something maybe people didn't anticipate was automotive sales. With lower gasoline prices in the United States, they're around around $2 a gallon. That would be 25 cents a liter in Canada. Well, SUV sales there are skyrocketing, and SUVs are the most profitable sector of any automotive manufacturer. So can we see at least gains for, the big three?
Yeah, well, also the light or pickup trucks have been part of that, and they've been heading up. So we're watching for that. Now, I just saw one this morning that China has had 3 months in a row of declining automotive and pickup truck sales. So it's somewhere here. Now, also here, that gets us back into the financial markets, is that people are financing these cars on a 7 or 8 year basis, and there's corporations developed that lend the money on this game, and then they're packaging the debt into bundles, and it's the same as with the housing bubble up to 2006, 2007. So this one Jim, is a good one to watch, the monthly car sales in the U.S., and the first downtick will be interesting. So, but in the meantime, it's been a madness. Buying SUVs and pickup trucks is the same madness as when they were buying houses in 2006.
Yeah, the difference being, though, houses are supposed to appreciate in value, or at least hold it. as you know, with any automotive product, the second you turn the key, you've lost about $5,000.
Yeah. Yeah, but if people have been leasing it, and I believe that a lot of the decision to buy it is not the amount of money you owe, not the price of the vehicle, but the monthly carry on it, So if you're paying $200 or $300 or $500 or $800 a month, that's the issue. And you never look at the value of the thing. And then if they're leasing it, I don't know how much you add on to the overall cost of it. So it's always been better just to go out and buy the car straight with cash. And, but mind you, even old collector's cars, sports cars, are still going up. And, but then that's sort of a collector's item, and art has been to the moon. Just unbelievable. You've got artists that are still alive today with paintings trading at $25 million. There's just unbelievable speculation going on out there. And that, of course, that shows up in where in a number of countries maybe average price houses have stalled out in price, but high-end stuff in New York and Vancouver and Toronto and London are just to the moon. They're paying. Oh yeah, that's my favorite one down in Los Angeles area, and we'll talk about this one from time to time, where there's a contractor building a spec house that he hopes to get $500 million for. And it's taken the top off of a hill, and this huge thing. Well, even I read that the master bedroom is 5,000 square feet. So we'll watch this one to see how that turns out. But so it is amazingly reckless, and one of the things behind that is that the central banks have been amazingly reckless, without precedent. So, but the central bank, in order to be reckless, has to have speculators out there taking on debt. And it's the old saying from the 1930s, it's like trying to push on a rope. And so this, as asset prices come down, is beginning to choke off the ability of the senior central banks in getting the credit expansion going. And it'll feed on itself. So, hey, let's look at the cars and high-end real estate, which has the very wealthy people engaged in the high-end real estate, and everybody else and all sorts of average people engaged in buying a new car, or there's a whole lot of financing done on the never for buying secondhand cars. So I think there's been nothing like it.
We're speaking with market historian Bob Hoye. You said people were willing to spend more money on exotic cars and antique cars. How does that translate to the rest of the market?
That's just top-end fluff up there. But when the stock market in Shanghai peaked in June and then broke hard, of course, the whole of the investment community, or most of them, said, "Oh, well, this is isolated. That's just China's problem, and it won't affect the rest of the world." It's natural. It's happened on bubbles before, but at any rate, the view is that when Shanghai peaked, it would spread out to the rest of the world, which has been the case. It was discovered in August. Now, here's the other thought: is that if China has had 3 months in a row of declining auto sales, why wouldn't that phenomena spread to the rest of the world? So this is where I think it's critical to watch in North America, particularly the U.S., the automobile sales on a monthly basis. And the first downtick, then that is following the China. So then the whole thing rolls over. So, and then of course that then is the amazing thing is if you had this automobile boom, which has a great consumer of metals, and you've had the long bear market in metals. It just shows that those peaks for metal prices in 2008 and then the other high in 2011. And remember, you would see stories in the papers about drug addicts going around stealing copper wire. No, you're not seeing any stories about that at all. So the prices for base metals became incredibly high, and they stayed high enough so that there was a huge expansion of capacity. And then at the same time, you had the many Chinese were positioning base metals as part of the loan market. There were many businesses that couldn't tap the regular loan market unless they went through the loop of positioning base metals in order to have a collateral. So that was that nonsense. So it takes many, many years to unwind the excesses of a financial mania. But we want to look here, like just recently, a commodity index we follow, the DBC. It made new lows a week ago, at the end of the month, of course. Well, that was with the Black Monday crash, August 24th. But most commodity indexes made new lows couple of weeks ago, and they've had a bounce, but they're still kind of weak, and we're going into a seasonality where wheat can be seasonally weak later in the year, copper into November, and crude oil seasonally weak into December, January. So this then lines up with the period of time when you can have a lot of liquidation going on in guys who can't hold stocks anymore. So we're not looking at very happy times out there.
What happens if the U.S. Fed decides it's time to hike interest rates?
I'm glad you asked that one. This has been one of the great absurdities. Just beyond the idea that the Fed could actually run things. But it started, who knows, a year and a half ago when I guess the responsible people within the Fed knew that it was being incredibly reckless on bond buying and quantitative easing and all that sort of stuff. And even some people within the Fed, spokesmen, were saying, hey, this is getting to be too much. So I think the discussion about raising the administered rate was a statement of, oh, we can be responsible. But of course, they never ever got the economic growth that their usual recipes of stimulus would result. So they never got the growth, and so they never ever moved on raising the discount rate. Now, there's another thought in here, Jim, and that is that in the 1930s, in the U.S., the T-bill rate went down to virtually zero, and Fed funds rate, or their equivalent then, the discount rate, was down to unbelievably low. So it could be a market forces thing that lowers rates inordinately, and when you look around at very safe money in uncertain times, it goes to the most liquid items, which have been T-bills in the senior currency, U.S., and it goes to gold. And so there are certainly natural forces holding interest rates down. So maybe, and this is the ironical part, maybe they couldn't raise the Fed funds rate if they wanted to. But at some time, if the storm gets hit hard enough, then various shorter dated rates would go up, maybe commercial paper and stuff like that, and definitely junk bond rates are going to go up. And you've also got a good one going on with the long dated treasuries, the treasury bonds, the bond future, or as we follow it through the ETF, the TLT. And now in 2000, 2007, and recently, when the stock market falters, they rush into long bond. And it's been called the flight to quality, and I never subscribe to that, because in a storm it goes to the most liquid item, which is T-bills. So at any rate, let's say there's been 3 big games where the treasury bond became the go-to place, and they bid it up tremendously. Now, we had a very good speculative high for bonds in January, February, and we advised that that could have been ending action on the whole bull market for bonds. So maybe this time, the next leg of the storm here in October, maybe the flight won't be to the long bond. Maybe it'll be just straight to Treasury bills. So then, in which case, you might the municipal bonds have been following the ups and downs in the Treasury market, and you got many municipalities and counties in the states that are facing insolvency, basically due to union huge pension fund demands. So it could be a storm there in the municipal bond market. And so we're in for a period of fascinating markets. We have been in. This year has been tremendous, and yet there's more to it.
Now, so many people were saying the reason you should buy equities is there's no growth anywhere else. But if it crashes, how was that advice?
Not so good. You've got Goldman Sachs here the other day come out and said they remain bullish on U.S. stocks. And I don't see it. Those bullish people now were not cautious in July, and then got offside, and then they become defensive. And yes, there will be a buying opportunity in here, but it won't be at the time when Goldman Sachs is bullish. And so we've got to look for. We just got to be careful. I think our readers got themselves build up a cash in the summer months because we kept beating it up on the fact that the bust in China would not be isolated; it would spread through the rest of the world. But so one of the other items that people have been disappointed in, of course, is the precious metal sector, and gold has not been acting well in U.S. dollars. But our view is people should own a little gold, physical gold, as an insurance, and you don't expect to make money out of your life insurance, so you don't expect to make money out of your careful insurance on gold. But in currencies that went down in the storm, Europe and various places, gold did go up. So I think one buys gold not looking for it to make money in U.S. dollars or Canadian dollars, but as your insurance thing. But gold has been firming up relative to other commodities and wages and stuff like that, and that's the old recipe for prosperity in the gold business in a post-bubble deflationary period, is that the price of most things, including wages, and this comes back to petroleum costs being down sharply relative to gold. So at some point, this difference between gold's price, the actual what they're getting for bullion, and what it costs the mining, that'll start to swing in favor of the gold producers. And this low, the forthcoming low in the general stock market, gold shares will be going down with it. But this then would present probably a very good opportunity to re-enter the gold stocks on there. Now, the silver bulls have always had a problem because every year there's more silver consumed than is produced, and they don't seem to understand that the difference between gold and silver, we call it the metallic credit spread, is that in a boom, the silver goes up relative to gold, so the gold-silver ratio goes down, and then in a bust, and you can go all the way back over 300 years, silver goes down relative to gold in a contraction. So we just don't consider silver as the poor man's gold. It'll make you even poorer. So, but when it's time on the gold and precious metal sector, the stocks, we're looking at a couple of indicators. You want to look at the gold shares relative to gold, and you want to have gold shares going up relative to gold, and this is now just stabilized for the last couple of weeks. And then also in a bull market for the metals themselves, you would want to have silver outperforming gold, and that's not happening. So let's just stay with our post-bubble deflationary condition whereby at some point the gold business becomes profitable when most industry and commerce is not so profitable.
Bob, thanks a lot for chatting with us.
Jim, it's good to be with you.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. His website, institutionaladvisors.com. That wraps up the show for this week. I'd like to thank our guests, Ross Clark and Bob Hoye, and thank you for listening. Comments or questions for This Week in Money can be emailed to info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of How Street Media Incorporated.